Welcome to the Opening Bell Report.
You know, there's a very specific, a very visceral feeling that every single investor knows.
Oh, yeah.
It's that moment. You open your portfolio app and you're expecting, I don't know, a quiet day, maybe a little green, and instead you get this jagged red line pointing straight down.
It's like missing a step on the stairs.
It is. Your stomach just drops.
It's the universal signal for panic in the reptilian part of the brain. The fight or flight just kicks right in.
Exactly. And that is exactly where we found ourselves looking today. We are talking about the iShares Silver Trust, ticker SLV. If you were watching, it wasn't pretty.
Not at all.
It's sitting at $81.02. Took a hit of $2.30 in a single session. That's a 2.76% drop.
Which, when you say it out loud, it doesn't sound like the world's ending. But when you're watching it evaporate in real time, 2.76% feels like the sky is falling.
Yeah, it feels like a crash. And the instinct, usually, is to run, sell, stop the bleeding.
Preserve capital.
But today, we're doing something a little different. We're digging into an analysis report that looks at this exact same red chart, this same drop to $81, and it comes to a completely different conclusion.
Right. This report isn't screaming sell. It is calmly whispering discount.
And we aren't talking about some vague buy-the-dip cheerleading here. This isn't just blind optimism.
No. This is a highly specific, data-driven thesis. It argues that if you look at the technicals, the fundamentals, and especially the industrial demand, this isn't a crisis. It's a calculated opportunity.
So that's our mission for this deep dive. We're going to figure out why a sophisticated analyst would look at a nearly 3% loss and see, green opportunities.
Yeah.
We're going to walk through the technical setup, this idea of the solar floor, which I honestly think is the game changer here.
It really is.
And the specific strategy laid out in the report. So let's unpack it. We're staring at $81.02. Why shouldn't we be scared?
Well, the first step is just contextualizing the drop. You said it, down 2.76%. The report frames this very specifically as profit-taking.
Okay, not a trend change.
Exactly, not a trend change. And to someone new, those might sound like the same thing. You're losing money, right?
Right. Red is red.
But there is a massive difference in market psychology between those two things.
Okay, so break that down for us. When I see red, I just think people are selling. What's the real distinction?
A trend change means the fundamental reason people were buying is gone. The story's over.
The company failed. The commodity is obsolete.
Something like that. Profit-taking it's just mechanics. It means people who bought in way earlier, maybe back when silver was at $26, they're looking at their huge gains and deciding, to cash in some chips.
So the asset isn't broken. The holders are just cashing out.
Precisely. And the analysis introduces a really interesting idea. It calls the 2.7% rule.
The 2.7% rule. I saw that. It sounds, I don't know, a little made up, but there's data behind this.
It's based on standard deviations. The idea is that in a strong, confirmed bull market, which silver has been in drops of this specific size, nearly 3% in one day, are actually rare. They're outliers.
It's not just business as usual.
No. And the report argues when you see an outlier drop like this inside a strong uptrend, you shouldn't see it as a warning sign. You should see it as a flush.
A flush.
It shakes out the nervous money, the weak hands. While the smart money, the institutional money, they step in. It's a momentary lapse in price, not in value.
I like that analogy. It's like if you're at a luxury store and suddenly everything's 3% off for 1 hour, you don't assume the store's going out of business.
Right. You assume it's a flash sale.
You don't ask, why is this cheap? You just grab it.
Exactly. You check to make sure it's real and you buy. And in this case, checking if it's real means looking at the technicals. And that brings us to the 20-day moving average.
I always hear about moving averages, the 50-day, the 200-day. Why does this report focus specifically on the 20-day line right now?
Because the 20-day is like the short-term pulse of a stock. It shows you the average price over the last month of trading. And here's the key. In strong uptrends, stocks don't go up in a straight line. They zigzag.
They need a place to rest, to pull back.
Exactly. And historically, in these strong runs, they tend to pull back right to that 20-day line before they bounce. The report uses the visual of a trampoline.
A trampoline, that's a great visual. It implies energy, a bounce.
Right. And right now, at around $81, SLV is hovering just above that line. It touched it. The report highlights that these touches of the 20-day moving average and strong uptrends are considered very high probability entry points.
And that's an important point. It's not just some guy looking at a line on a chart. It's institutional computers programmed to buy at that average.
Correct. So you have a convergence, you have retail investors panicking because of the big red candle, and you have institutional algorithms buying because it hit the moving average. This is what the report calls the discount zone.
So technically, we're standing on the trampoline right now.
Mm-hmm.
But you still have to zoom out a bit to feel comfortable.
You have to. The report really emphasizes visualizing the timeline. If you just look at the one-day chart, it's a cliff dive, looks awful. But if you overlay that against the 52-week range, I mean, we've rallied from lows of $26 not that long ago.
Right. When you see the whole picture, a $2.30 drop is.
Yeah.
It's just a blip. It's noise. You can barely see it on the long-term chart.
It's just a little jagged edge on a massive mountain.
It really puts it in perspective. But there's one more technical thing the report points to that I think explains why the drop happened. The RSI.
The Relative Strength Index. Yeah, think of this as like the thermometer for the stock. Measures how hot or cold the price is.
And SLV was running a fever.
It was burning up. When a stock rallies that hard, the RSI shoots up. And when it crosses a certain line, it becomes overbought.
Meaning it stretched too far too fast.
Like a rubber band about to snap back. And before this drop, SLV was running very, very hot. So this 2.76% drop served a specific technical function. It wasn't a crash, it was a release valve.
You let the steam out.
Exactly. It reset the indicator from overbought down to just buyable. It gave the stock room to breathe so it can start climbing again. Paradoxically, the stock is healthier now at $81 than it was yesterday at $83.
That's a great way to put it. Okay, so technicals seem to line up, but charts are just lines. If the real world doesn't back it up, the lines can fail. I really want to talk about the fundamentals, specifically this solar floor.
This is, in my opinion, the most critical part of the entire thesis. If you take nothing else away from this, understand the solar floor. This is the why now.
Okay, lay it on me. Because usually people talk silver, they talk coins, jewelry.
Right, poor man's gold, inflation hedge. But that narrative is shifting fast. Silver is becoming a strategic industrial necessity, and the driver is the energy transition.
Specifically solar energy.
Specifically solar.
We know solar's growing, but how much silver are we talking about here?
It is so much more than people realize. The analysis report cites this one key stat that it really puts it in perspective. Photovoltaic demand solar panels is projected to consume roughly 20% of the entire annual silver supply by 2026.
Wait, say that again? 1/5 of all the silver mined on the entire planet is going to end up inside a solar panel.
1/5. And here's why that creates a floor under the price.
Right.
If you're an investor, you can choose to sell if the price drops. You can panic.
Sure, you can walk away.
But if you are a manufacturer for, say, Tesla or SolarEdge, and you need to produce panels to meet your targets, you cannot choose not to buy.
You have to have the silver to make the product. There's no substitute.
It is a non-negotiable ingredient. It's the most conductive metal on Earth. So these industrial buyers, they must buy. Regardless of what the chart looks like, that creates what the report calls a hard floor under the price.
That's a really powerful concept. Investors might be emotional, but the industry is desperate.
Exactly. The industry provides a backstop. Even if speculators flee, the factories still need to run. That's what we call inelastic demand. They will pay $81, they'll pay $90, they'll pay $100, because the alternative is shutting down the factory.
And there's another layer to this, right? The relationship with gold.
The gold-silver ratio, or the GSR, a classic metric.
And gold has been on a tear.
Gold just hit all-time highs. It's been leading this entire rally. And historically, silver and gold, they dance together. But right now, gold is way out in front.
So silver is the laggard. It's playing catch-up.
It's playing catch-up. And the argument in the report is that at $81, silver is statistically cheap relative to where gold is. It implies that SLV has a catch-up trade pending.
Meaning it has room to run just to get back to its normal relationship with gold.
Correct. It's like a rubber band connects the two. If gold pulls too far ahead, the tension builds, and eventually silver has to snap forward to close that gap.
Okay, so let's recap for a second. We've got a technical pullback to a support line, the trampoline. We have a massive industrial buyer, the solar industry, putting a floor under the price. And we have gold signaling that silver's undervalued. So if I'm listening to this and I'm thinking, okay, the logic is sound. How do I actually do this? The report outlines a very specific strategy.
It does, and I love this about the analysis. It goes from theory to action. It breaks it down into zones.
Let's walk through them. We're at $81.02 right now. What zone is this?
The report labels this the nibble zone.
The nibble zone. I like that. It sounds cautious, not
Yeah.
all in.
It's prudent. The strategy suggests scaling in small positions here. You don't bet the farm at $81. You take a bite. You start the position.
Because it could still go lower.
Oh, absolutely. Markets are irrational, and that leads to the next level, the loading zone.
And where's that?
That's down at $78.50.
$78.50. Why that number specifically?
It comes down to market memory. $78.50 was a previous resistance level, a ceiling that the stock struggled to break through. And in technical analysis, once you break through a ceiling,
Old resistance becomes new support.
it becomes a floor, exactly. The report argues if SLV dips to $78.50, the risk-reward becomes heavily skewed to the upside. That's where you go from nibbling to loading.
So that's where you back up the truck.
That's where you have high conviction.
Yeah.
But, and this is so crucial, every good trade needs an exit plan, a safety net.
Where's the eject button?
The report suggests a hard stop loss at $77.
So 77, that's pretty tight, only $1.50 below the loading zone.
It is, but it's about managing risk. If it breaks $77, the trampoline thesis might be broken. The moving average has failed. At that point, you don't hold and hope, you preserve your capital.
Take the small loss, live to fight another day.
Exactly. But let's talk about the fun part, the upside. If the trampoline holds, where are we going?
The targets.
The immediate target is the breakout. That's at $85.30.
The 52-week high.
Right. Just getting back there is a gain of about 5.3% from here. That's the first milestone.
And if we clear that?
Then we get into the blue sky territory. The report sets a big psychological target for 2026, $100.
Triple digits.
They call it the dream trade. It's a nice round number. Psychological barriers are real, and once you clear $85, the path to $100 has very little resistance.
Okay, so we have the strategy. Nibble at $81, load at $78.50, stop at $77, aim for $100. But there is one elephant in the room, the vehicle. Yeah. We're talking about SLV, the iShares Silver Trust. And I know some listeners are screaming, if you don't hold it, you don't own it.
The physical silver crowd. They are very passionate. Don't buy paper silver, buy coins.
And it's a valid philosophy for a certain type of investing, right? For insurance against the apocalypse.
Yeah.
But why does this report specifically argue for SLV for this trade?
It's all about the goal. This thesis is about trading volatility. It's not about prepping for the collapse of the dollar. It's about capturing a price move over a few weeks or months.
So what makes SLV better for that?
Speed and liquidity. I mean, think about the mechanics. The dip is happening right now. If you want to buy physical, you go online, you find a dealer, you pay a big premium over the spot price.
Right, you're paying for minting, shipping, the dealer's profit.
So you're instantly down maybe 10% the second you buy. Then you wait for it to ship. By the time it arrives, the market could be somewhere completely different. With SLV, you buy the dip instantly.
Click of a button.
Instant execution. And then there's the spread, the difference between the buy and sell price. With SLV, it's what they call punny spreads. You can enter at $81.02 and exit at $81.10. It's incredibly liquid.
And that liquidity is key for that stop-loss strategy we just talked about.
Precisely. We said have a hard stop at $77. If the price hits $77, you click sell on SLV and you are out. You cannot execute a stop loss on a stack of coins in your basement.
That is a very, very good point. You can't exactly sell your coins to the internet at 2 a.m. if the price crashes.
Not a chance. SLV is the superior vehicle for this specific tactical trade. It's a tool. If you want insurance, buy physical. If you want to trade the solar floor thesis, you use the ETF.
So let's bring this all back home. We started this deep dive looking at a really scary chart, a sea of red.
And through this analysis, we've kind of dissected why that fear might be misplaced.
We have the 2.7% rule. These drops are rare gifts. We have the technical support, the 20-day moving average, that trampoline for the price. We have the RSI reset.
And fundamentally, we have that solar floor, that 20% of global supply going to solar panels by 2026. I mean, that is the bedrock of this whole thing.
It really shifts the mindset, doesn't it? The report says most people see this and get scared. I see this and get greedy.
It's the classic contrarian approach.
Yeah.
But it's not just being contrary for the sake of it. It's being contrarian with data. It's saying this dip doesn't make fundamental sense because the factories need this metal, so I'm going to exploit the market's irrationality.
There's a difference between emotional trading and analytical trading, really.
One reacts to the past, the other anticipates the future.
So as we wrap up, I want to leave you with one final thought. We've talked a lot about the price, $81, $100. But think about that industrial buyer again, the procurement guy at the solar factory.
The one who needs the silver to keep his job.
Right. For us, on a screen, silver is a ticker symbol. It's a number. But for the energy transition, it's a physical ingredient, an atom.
A molecule that conducts electricity better than anything else.
So if the solar industry truly needs 20% of the global supply to meet energy targets, does the price on the chart actually matter to them?
That is the question, isn't it?
If silver goes to $100 or $150, does Tesla stop making solar roofs? Do they say, oh, well, too expensive, let's stop the green energy revolution? Or do they just pay whatever it takes?
If it's an essential component, demand is inelastic, they'll pay. The cost of the silver is a fraction of the total panel cost anyway. They'll just pay.
And if they're willing to pay whatever it takes, what does that imply for the floor price of silver in, say, a recession? Even if the economy slows, if the energy transition keeps going, that floor might be a lot higher than anyone thinks.
That's a fascinating thought. It completely decouples the commodity from the general economy. It stops being just a metal and becomes a strategic energy asset.
Something to mull over next time you see a red chart and feel that pang of panic. Maybe it's not a warning. Maybe it's just the market taking a breath before the industry steps in and buys everything in sight.
A very profitable breath if you know where to look.
Exactly. That's all for this deep dive. Thanks for listening, and we'll catch you on the next one.
Happy trading.
Don't forget to like, share, and subscribe for more.